risk-adjusted discount rate sometimes we call it that. So the risk-adjusted discount rate. Discount rates are normally the rate of interest or rate of return. When you are investing, the rate of return is what we call discount rate. The discount rate can be a cost to somebody, it can be a return to another person. Because, for example, let's say that you are having fixed deposit. That fixed deposit is going to be at a certain rate, maybe 8% with the bank. To you, it is an income, but to the bank, it is a cost. So that rate can be a cost to you when it is an income to the other person. It can be an income to you when it is a cost to another person. That discount rate could have taken into consideration the risk element, the possibility that the changes can happen. Inflation can be there, such things. So we need to adjust the discount rate, the rate of return. We need to adjust it. We add the risk element on it so that we have a rate of return that is real. Because it is true that in business, the risk is there. So you have to think about risk. You don't assume that you get everything easy. So we shall be able to do that. Risk-adjusted discount rate, we shall be able to learn about it. We have decision tree, number 6. We have decision tree in NPV. We should look at ways you can make decision whether to invest or not. That is a decision that you have to make. The next one, we have inflation and capital budgeting. Inflation in capital budgeting, that is number 7. So that is lesson 7 or lesson 8. Inflation in capital budgeting. So if you are not missing any class, that means that we are in the 3rd week, because these ones will be 1 week. These ones will be another week. We are on the 3rd week of the semester. Almost a month, we are in topic number 1. 3rd week. Inflation and capital budgeting. The next one, we need to look at projects with an equal lifespan, or with what we call annuity equivalent values. So we have projects with an equal lifespan. How do you compare projects which do not have the same lifespan? With an equal lifespan. Projects with an equal lifespan. Projects with an equal lifespan. You have 2 projects, one is going for 5 years, another one 3 years, with different returns. How can you make decisions on which one to invest in and which one to leave out? Number 9. Annuity equivalent value. Annuity equivalent value. Then we have replacement analysis. Annuity equivalent value, a replacement analysis. Replacement analysis. We have capital rationing. Capital rationing. So this is where you have a little capital and you want to invest in projects. So you have like 5 projects to invest in with some small amount of money. You need to know which one to leave out and which one to proceed with. You have to ratio the capital that you have to fit or get you the maximum output. Tuko na project A, B, C, D. So you need to know, can I get project D and take the rest? Because niko na pesa kidogo. Or should I invest in project A and B and C and leave the D? Such kind of things we shall be able to look at. And here we shall be looking at profitability index. So to make decision on capital rationing, you need to consider profitability index. Profitability index. Profitability index. Profitability index. And then the last part is linear programming. In capital budgeting, linear programming in capital budgeting. So in other words, we shall take a minimum of 3 weeks, or basically around 12 lessons to cover the topic number 1. We need 12 lessons or a whole month to cover topic number 1. So are we ready to start? I can just do some introduction of the first one, and then we shall do more in our next lesson. Unless somebody has questions. Anybody with questions? As usual, we shall be doing past paper revision as we move. My style of teaching, because of the limited time that we have, I normally introduce, give example from the past paper, then we move to another one so that we can save time. Some students will tell me at the end of the lesson, well, can we do example on question number 1? When actually we did example in question number 1 from the past paper, So it is important that you attend class to avoid getting confusion. So let's start with simulation analysis. So I want to say that to simulate is to imitate a reality. To simulate is to imitate reality. Simulate is to imitate reality. To simulate is to imitate reality. So let's talk about random numbers. Let's say that we have random numbers. Simulation uses random numbers. Random number ranges. So let's say that the price of some commodities are given like this. You are selling a commodity with the price as follows. So we have price, and then we have the probability. And then we have, let's say that at 10 bob, the probability that you can sell something at 10 bob. To simulate is to imitate a reality, to imitate, to copy, imitate reality. I gave an example of that you could be copying from what was there before. So let's say that you want to sell a product and you want to set the price. So you are asking yourself, what if I say it is 10 bob? Will I get customers? Like us, if we put online classes to be 5,000, you guys might shy away. So we have to look for the price that is able to work, that can allow teachers to pay bills, and also can allow you to manage. You can manage to pay. So we have to balance. So we are saying that if we set the price to be 10 bob, the probability that it can work is 0.3. If we say that the prices are 12 bob, for example, the probability of having it at 12 bob and it becomes workable is 0.2. Then we have the probability 13 to be 0.5. At the end of the day, the probabilities must add up to 1. So if that is the case, then we can have our accumulated probability. So what we are saying, we are trying to set the price that is working. Anyway, whenever you're given the probability, just know that these are things that are just possible, but the mean is there. We need to get the price that can be able to work. So 10 bob, the probability is 0.3. 12 bob, the probability is 0.2. 13, the probability is 0.5. So therefore, we shall be able to determine the actual price that we can use. The price that is mean, or the mean price, or the average price that can be used. So with this, whenever you're given probability, the next step is to accumulate. They will give you this like that only, plus the random number ranges or random numbers. So you need to know what are the ranges of random number. Range is between this to this, this to this. That is a range. Between, for example, 0 to maybe 0.2. That is range. So you need to know the ranges for the random numbers. So random numbers will be given separately. Now use this to create the range. And that is why this one is called random number ranges. They have only given us this, but I have to create the ranges now. So what I'm making is the random number ranges. Examiner will only give you the item and the probability plus the random numbers. But the range, it is up to you now to make the random number ranges. So let's start. You accumulate. When you want to make the random number ranges, you accumulate the probability. So we start with this one. Here 0.3. Then we have 0.5. You add now this on this. Here we have this on this 1.0. The final figure must be 1 for probability when you are accumulating. First, have the figure. Add this one on the previous one. You get the current accumulated figure. Then you go like that. That is number 1. Rule number 1, it has to be 1. The total must be 1 when you are accumulating probability. So cumulative probability must be 1. Cumulative probability. That's number 1 rule. Number 2, the range depends on the decimal places that you're given. In this case, we only have 1 decimal place. So the range should also have 1 decimal. 1 digit. The range must be as per the decimal places. If you are given here 1 decimal place, the range will be 1 digit. If you are given 2 decimal places, the range will be having 2 digits. The digits that, for example, you might be having 0, 0, 2, 2, 9. 2, 9 are the digits. 2, 9 are digits. So 2, 9 are the digits. If you are given 2 digits here, 2 decimal places here, then the digits can be 2. Not can be, but must be 2. If you are given 1, the digit can never be 2. It can only be 1 because the decimal places are also 1. That is rule number 2. Rule number 2 is that decimal places determines the number of digits that you're going to have when you are now expanding. When you are now creating the random number ranges between this and this, the digits must be the same as the decimal places. Rule number 2. Rule number 3. Rule number 3. The digits here must be in line. It must conform with the random numbers. So in case you are given random numbers are given us, they are telling you that the random numbers are 22 or 23, 45, they're in that order. 39, 50, 60. These ones the examiner has done for you. This is a very good examiner. He has told you that the range are in 2, 2. So automatically you know that the range here should also be in 2, 2. So this is what we call random number ranges. So the range is in 2, 2. If this one is 2, the ones that you're going to pick, the random numbers must also be in 2. In some cases, the examiner might not look for you. He might not look for you. He might give you a number that is just continuous. So we have 14, we have 29, 36, 50, 61, 75, 72. These are just continuing numbers. How will you know how to pick it here? What will help you to know how to pick them from here is the range. Kama range hapa ni mbili mbili, then you have to pick them into 2, 2. If the range is 1, then you pick one at a time. You pick this one, then in the second one, you come and pick the next one, 1, 1. You don't pick 2, 2 until the last. So what will guide you how to pick it from here is the random number range. And random number range is determined by the digits, the decimal places here. So it means that this one is very important. It will tell you what to have here, and this one will tell you how to pick from here. Because you'll be saying that the next random number is 36, you picked it too. Where does 36 falls? Maybe 36 falls between here, 0.2, or we can say 0.2 to 0.5. If they're in decimals, it could be maybe 22 to 40, 49. So 36 falls between this and this. Then you know that the price that you pick is this one. So it means that you need to understand from here, then here, then from this one, it will help you to know how to pick. If they are 1, 1, pick 1, 1. Because you cannot find 9 ranging. 9 cannot range here. If you get it wrong here, everything will range here in the first one. Because if you are picking 1, 1, there is no way you will meet 21 or 22 or here. Everything will be between 0 to 20, 23 or 21. So that is again something that you need to understand. That rule is very important for you. So what we are making here is a table that shows the range of the random numbers. Now that we have only one decimal place, it means that our random numbers must also have one digit. So we come to random number ranges, Rn ranges. You range them using probability. And when you are making them, now that we know that they are one digit, the next thing, when you are putting the ranges, you ignore the decimal places. Ignore the decimal places. Assume that it's only 3, it's only 5, it's only 10. Ignore the decimal places when you are now making the ranges. That is number one. Number two, the upper limit in this range should be the figure that you're having here. The lower limit of this one. So if it is 3, we have assumed that this one, there is no decimal. So we assume that this one is 3. 1 minus this figure will be the upper limit. If this one is 5, 1 minus this figure will be the upper limit. So that means that if it is the upper limit, we are now saying that 0 to 1 minus this, 2. So 2 is 1 minus this figure. It is the upper limit. Here we have 5. So if it is 5, we had reached 2, so we continue from 3. 3 to 1 minus this, that is 4. We come here, 5 now starts. 1 minus this is 9. 1 minus 10 is 9. That is the range. So you need to remember Another thing, when you are creating the random number ranges, you need to remember that we ignore the decimal, these decimals. We assume that they are all figures. We start with the lower limit, which is 0, that is the beginning, to 1 less the figure that you're having here. 1 less the figure that you're having here, and then you continue like that. Assume that we are having more decimal places, like now 2. How will it appear? So first, I want to write that one, the range is up to there, and then we want to do another one where we now have additional decimal place. How will it appear? Andika hiyo kwanza. So let's look at example 2. Ascertain random number ranges for the following. Example 2. Illustration 2. Ascertain random number ranges for the following. We have year, we have year 1 cash flow. Let me just say year 1 cash flow. So in year 1, there are probabilities that these cash flows will be found. The first one is 10. Then we have 12. Then we have 20 and 25. Then we have probability 0.4, 0.2, and 0.1. Can you guys get me the random number ranges? In case you're given something like this, what is the random number ranges? Just do it. Then when you are done, you let me know. You'll read for me that the first one between this and this. The second one between this and this. How will you handle this? No, I think I'm almost giving an exact thing like the other one. Let me have this one at 30. So we have 30, 40, 20, 10. Get me the random number ranges. The first one, thank you. Ruth has given me here 0 to 29. So you start with 0 to 29. Even 0 should be in 2. Sawa. Yes, 0 to 29. Thank you. Then we have 30 to 60, 70 to 80. Are you sure? And then we have 90 to 90. What are you getting? Okay. Alex ameondoka. Another person. So we agree that you have the cumulative first. You have the cumulative first. So let's calculate the cumulative probability. Then we are having here 0.30. Here we're going to have 0.7 because we just add. Eh? So you add 0.7, this one you add 0.90, and then you have 1.00. Siko hivyo. Agreed. Agreed. Now let's have our let's come to our random number ranges now. We want to rate them random number ranges. So Rn ranges. So we write them. So we start with the 0, 0 to 29. That is true because we assume that this one is 30. You ignore the decimal, you assume it is 30. So 1 less that is 29. Then now we have 30. 2, 1 less this. 1 less this. Ngapi? 69. Still. So we have 69. Then we have 70 now. 70 becomes the opening, just the way 30 was the opening, the lower limit. 72, 1 less this, 1 less 90 is 89. So we have 89. And then we come here, 90 is the opening. 1 less 100 is 92, 99. Was it challenging? Was it? Was it challenging? You can't speak. Okay. I hope that you're now okay. You can talk.
I had missed the decimal thing, so lakini sahi imestick kwa akili.
Mistake. So that is year 1. So assuming that these are the year 1 revenues, then let's now get year 2. Let's now try to get year 2 revenues. Assuming that the business, we are in a situation where you want to make decisions on how to spend. So what you're saying is that you want to invest in a project that can give you year 1 revenues, year 2 revenues, year 3 revenues. So you're saying that in year 1, there is a probability that the revenue or the price can be 10 shillings, and that is this one. The probability of the price being 12 is this one, in year 1 only. So these are not years. Year need the whole of it. The whole of it. Year 1, there is a probability of 10, 30%, 10, 40%, 12, 20%, like that. Now, let's look at year 2. How will the prices of the revenue be in year 2? In year 2, that is Y2, we are going to have, we have 10, we have 15, 15 here, we have 6, we have 7. So that we have 30, we have 20. Then we have 20 again. Then we have 0.3. I say that it has to be total of 1. It has to add up to 1 because the probability adds up to 1%, 100%, which is basically 1 there. Can we try this one again? So the same way we can have because of time, let's just proceed. We have our 0.30. Then you add now this one on this, we have 0.50. We have this one, add there 0.70. We have 1.00. Then you can expand them so that you have 0.002, 29. We have 30 to 49 because 1 less 50. Then we have 50 to 69. Then we have 70 to 99, right? 70 to 99. Very simple like that. Let me get you one example, one assignment that you're going to do for me. We shall pick from there in our next class. For year 3. Ama hii mnaweza fanya sahihi. Let's see year 3. So year 3, we have year 3 is 10. Then we have 8. We have 10. Then we have 30. We have 50 and 20. This one you can also expand. You can expand this one to be 0.30, right? Then you have 0.80. You can have now 1.0 still. Are we together? So our ranges are 00 to 29. Our ranges are 30 to 79.
Yep.
Because of this, then we have 80 to 99. So we say that consider the following information. Consider additional information. Additional information. The rate of capital is 12%. That is the rate of capital. Rate of capital is 12%. Assuming that you're given that the rate of capital is 12%. All right. And then initial cost of investment is 27 million. Initial cost of investment is 27 million. Calculate NPV. Calculate NPV of the project. Calculate NPV of the project. Calculate NPV of the project. So given this information on the same project, the project that can give you revenue in year 1, year 2, year 3, as we have seen, and then you're told that there is additional information, the rate of capital is 12%, and the initial cost of investment is 27 million. Calculate NPV. So we know how to get NPV still. So anytime you are asked about NPV, or you are told to advise the management on whether the project is viable, when you're told to advise the management on whether the project is viable, those people are basically telling you to calculate the NPV and check whether it is positive or negative. If it is a positive NPV, that is a positive profit, right? That is a profit. If it is negative, that is a deficit, loss. So we can check NPV. So NPV is normally the cash flow, and we know where to get the cash flow. It is a free cash flow, which you can say free cash flow. Free cash flow. It is cash flow that is not attached on anything. A free cash flow is cash flow that does not have anything attached on it. Ushatoa kila kitu, imebaki tu the investment cost. Ushatoa other cost, running cost, imebaki tu ka profit before utoe initial investment. That is a free cash flow. So it is normally free cash flow times the PV part, or PV minus initial outlay. So this cash flow is basically the total revenue minus total cost before we remove the cost of investment. So therefore, from here, we can see that we need something called PV fund. We have to discount. We call it discounting factor. This one is called discounting factor. We have to discount. And when you're discounting, there are two things that you need to consider. We have regular cash flows and irregular cash flow. Regular cash flows are the same every time, every year, they are the same amount of money that is coming in. So we have formula for that. And then we have formula for irregular cash flow. So for regular cash flow, we normally have the formula which we can use. When you realize that cash flow here is regular, the discounting factor, which we call the present present value interest factor, is now called PVFA. Regular cash flow is also called annuity. So therefore, we use this present value interest factor of annuity. Present value interest factor of annuity. If it is regular. If it is irregular, we use present value interest factor only without adding A. There is no annuity. Present value interest factor, just like that. If it is irregular. If it is regular, we use this. So the formulas are also different. For regular cash flows, discounting factor is gotten by 1 into 1 plus R into 1 minus N all over R. Remember, this R is under the whole of this. When I was young, when I was still learning this, I used to have 1 outside. So now I can use R over this peke yake, and that is a mistake. It is over the whole of this. But for irregular cash flows, discounting factor you can get by saying 1 plus R into 1 minus N, just like that. So you need to know the differences between the two. In this particular advanced FM, this formula you will use until you do exam. Here, kwanza. You shall be using it, so it is better you cram, master it, put it somewhere in your head where you can't forget it. You'll use it forever. Every time you'll be applying it. Because in capital budgeting, the main aim is to get NPV. And for you to have the NPV, you need to use the formula here. So the question is whether it is regular or irregular. If it is regular, use this formula. If it is regular, use this formula. But you have to use it. So the one for regular, we call it PVFA. And that is the formula for PVFA. This one we call PV. So if I ask you in our next class, these ones you can do to know. IO means initial outlay. It is the initial cost of investment, the initial money that you laid out. So unaweza buy machine sahi tingatinga inafanya kazi. There is cost of tingatinga and then there is cost of running it. The cost of tingatinga is what we call initial outlay. It is the cost of buying the machine or the initial cost of investment. Then the running cost, you'll knock it off with the revenue to get free cash flow. So it is going to be deducted here. Free cash flow. Itakuwa huku. Sawa sawa. Now, in this example, we know from the formula that we have to use something. Now that we need to get NPV, we are told. And for us to get the NPV, we need to know whether the cash flows are regular or not. We can see from year 1, year 2, year 3, the cash flows are different from the example that we have seen. They are not the same throughout. So we're going to use PV. That is number 1. Number 2, when you're using PV, we need to know where R is. And R we have been given. That is the cost of capital. R is the cost of capital. Then N is the number of years. So for discounting factor, PV, we calculate yearly separately. Year 1 separate, year 2 separate, year 3 separate. But for PVFA, we just put the total number of years here. If it is 6 years, we just put here. We don't calculate separately. We shall be able to see that. In PV, you calculate each year. Year 1, you put N year 1, then N2, N3. But for annuity, you put the whole of 6 years together. You don't calculate separately. So we have our initial outlay, we have our R, we know the number of years. We have 3 years for that investment to generate income. Year 1, we have been given. Year 2, we have been given, and year 3. Still. So we can be able to calculate our discounting factor. That is where we start from. We shall just do discounting factor and then we stop there because of time. We discounting factor. So we calculate discounting factor for year one, right? So year one, we need to know discounting factor for year one is, we'll have 1 plus r into -1, still. And we have that, we've been given, so we have 1 plus r is 0.12 into -1. In this class, you have to come with a calculator. Let's agree. Next time, come with a calculator. So that one is going to be 1.1 raised to -1. What is the answer? Then year 2, we have 1 plus r -2, which is the same as 1 plus 0.12 -2, which is the same as 1.12 -2. What is the answer? That is the discounting factor. Then year 3. That is for year 3. Then we have 1 plus 1.12 -3. Get me those ones, and then we go. Discounting factors, then we go. What are the figures? Year 1 ni ngapi? Year 2 ni ngapi? Year 3 ni ngapi?
Year 1 ni 0.8929.
Year 2?
892. Year 2 ni 0.7972.
Year 3 should be 0.6 something or 7 lower figure. 0.7 what?
0.7118.
So those are discounting factor. I repeat, for irregular cash flows are not the same every year. Use PVIF. And for PVIF, this is the formula. You need to calculate PVIF for each year separately. We call them discounting factors. Those PVIF, you calculate each year. Year 1, put 1 there. Year 2, year 3, this one is 3. Year 4, like that, back at the end. Then we have the discounting factors. So when we are calculating our NPV, normal NPV, we can have now cash flow, which can be 10, 20. Then we have discounting factor here. You now put per year 0.8929, 0.7972, 0.711. Say even this one is 15. So you have 7118. Then you now multiply this cash flow and the discounting factor. It means that cash flow should have been 10, but because of the decrease in the value of money, we have discounted it. So it is going to be lower. So we are saying that 10,000 at the end of year 1 cannot be 10,000 again. It will be equivalent to 8,000. 15,000 at the end of the second year or 2 years, it will not be 15 again. It will be a lower figure. So you are discounting this cash flow to get its equivalent today. The equivalent today is what we call present value. This is the present value. So this one is a future cash flow. But presently, if you don't discount it or get its equivalent today, it can be less than that. So 10,000 in the next 1 year is equal to 8,900 today. So discounting factors are used to reduce or to bring back the value of the future cash flows to their equivalent today. So if you multiply the discounting factor with the cash flow, you get the present value. The total present value here minus cash flow minus initial outlay gives you the net present value. We shall proceed from there in our next class to look at how we can do simulation worksheet. So we have the figures already. We shall now use the worksheet for the run of, for 6 years we see, or 6 attempts, we see how it works. We shall now simulate. Then look for question paper November 2016. That is the example that we shall do. November 2016, question number B. Question number 1B. November 2016, question number 1B. That is the example that we shall do. Any question?
November
2016, question number 1B.
November 2016 question B.
Angalia your question. Yeah. So please, let's try to bring more students. Market for us the college, so that we can have more students, so that we can move together. Your class is very interesting. I know wengine wanakuja, but we need at least 40 to 50 students in this class. Last semester we had around 30. We need to have more than that, around 35 last semester. So kazi kwenyu, let's get more students to join us. Have a good night.